Having discussed in some detail about 4 asset classes: equity, debt, gold and real estate, or commodities and real estate, let's move to asset allocation. Asset allocation is the process by which, if you have $100,000 of saving with you, you decide what percentage of it will go towards these 4, 5 or 6 asset classes in what proportion. This is certainly an exercise for the expert, and how you allocate will depend on your risk profile. And today there are many tests that can be administered which will tease out your risk tolerance. It's very hard for someone to ask you and say, what is your risk tolerance? And you cannot give an answer saying it's 5 out of 10 or 7 out of 10 or 9 out of 10. It has to be teased out of investor, and there are enough techniques and instruments available to do this. Once the risk profile is established, you then have a formulaic way of deciding how do you allocate this $100,000 between equity, debt, real estate, commodity or gold, and maybe alternate assets as well. Asset allocation is a science which has many nuances. It has many classifications. The way you allocate, there could be an aggressive way of asset allocation, in which case you have a high proportion of equity, lower proportion of debt. Or it could be moderate, which means it is balanced, or it could be very conservative. It's a function of your risk profile, which in turn is a function of what kind of commitments you have in life and your age, meaning at what stage in life you are. If you are just about to retire, what allocation you choose depends on a number of factors. The risk which you are able to tolerate, which in turn would depend on what stage of the life you are in. If you're about to retire, you want to be more conservative because your source of income will dry up, and it's only these passive investments which have to yield to you, and you want to be careful not to let that get devalued substantially, as it can happen with stocks or shares, which happened in 99, 2000 or 2008, or in 2020, 21 during the pandemic. Once you allocate once you go through an asset allocation, you then rebalance it from time to time. Let's say you decide on 50% shares, 30% debt, 10% real estate, and 10% cash and gold. That could be a typical asset allocation. If stocks do very well, all of a sudden its value could go up, in which case the ratio will skew more and more towards, say, 60% or 65%. In which case you would sell some of these stocks and add it back to the other remaining asset classes like debt and gold and real estate to once again bring it back to the same ratio. And as you progress in life, you then skew more and more towards being conservative with passing of years as you approach close to retirement. And then you finally, at the time of retirement, you have a profile where the balancing is done in such a way that there is more dependence on lower risk asset classes than on higher risk asset classes. Often it is said that the success of a long-term investment is not determined by the stocks you pick, but it is by the asset allocation that you do. That is the ratio in which you assign all of this. Within equity, yes, then you have to create a portfolio. It could be shares bought directly, it could be mutual fund which is active, or it could be mutual fund passive, it could be ETF. And as I said, that would be the job of an expert to come back and advise you on how to distribute it within a particular asset class. But asset allocation clearly determines the health of the investment and how well optimized it is in the long term.
Thank you for watching. If you want to dive deeper into this topic and stay updated on our latest content, be sure to subscribe now. And if you found this video helpful, don't hesitate to share it with someone you know. Let's spread the knowledge and the fun together.